Here's something your real estate agent probably didn't mention when you bought your dream home, and your mortgage lender definitely kept quiet about it too. The monthly payment you locked in, that's actually the smallest part of what you'll really pay. I'm not talking about repairs or renovations. I'm talking about the silent wealth destroyer that's crushing homeowners right now across America. A cost that rises every single year, a burden that never goes away, a bill that can literally force you out of the home you own. Property taxes. And in 7 specific housing markets across the United States, this financial pressure is reaching a breaking point. Not tomorrow, not in 5 years, right now. See, most Americans focus entirely on their mortgage when buying a home. They calculate what they can afford based on that monthly payment. But here's the uncomfortable truth that's about to slam into millions of homeowners. While your mortgage stays relatively stable over 30 years, your property tax bill can double, triple, or even quadruple. In some states, homeowners who bought 5 years ago are now paying 60% more in property taxes than when they first moved in. Their mortgage didn't change. Their income didn't necessarily increase, but their tax bill exploded. Today, I'm breaking down the 7 housing markets where property taxes are set to devastate homeowners. More importantly, I'll show you the exact warning signs to watch for, the financial moves you need to make right now if you live in one of these danger zones, and the hidden escape routes most people never even know exist. Before we dive into specific markets, you need to understand why this is happening now. Property taxes aren't just rising because governments want more money. There's a perfect storm brewing in American real estate, and it's built on 3 unstoppable forces that are colliding right now. Force number 1, assessment inflation. Your home's assessed value determines your tax bill. During the pandemic, home prices skyrocketed. In many markets, homes appreciated 40 to 50% in just 2 years. Now, tax assessors are playing catch up. They're reevaluating properties based on those inflated peak prices, even though the market has cooled. But your tax bill? It's locked in at those highs. Force number 2, municipal budget crisis. Cities and counties across America are facing massive budget shortfalls. Why? Declining commercial real estate tax revenue. With office buildings sitting empty, shopping malls dying, and retail spaces vacant, the municipalities have lost billions in commercial property tax income. Who's picking up the slack? Residential homeowners. You're literally subsidizing empty office towers. Force number 3, the insurance tax death spiral. Homeowners' insurance costs have exploded, especially in disaster-prone regions. When insurance companies stop covering homes in certain areas, property values should drop. But tax assessors aren't adjusting valuations downward fast enough, so you're paying higher taxes on a home that's becoming progressively less valuable and harder to insure. Now multiply these 3 forces across an entire housing market, and you get what financial experts are calling the tax trap crisis. Homeowners are stuck. They can't refinance because rates are higher. They can't sell because nobody wants to buy into a high tax market. And they can't afford to stay because their tax bills keep climbing. This is exactly what's happening in 7 specific markets right now. And if you live in one of them, your financial situation could deteriorate faster than you realize. Market 7, Phoenix, Arizona. Phoenix seemed like a real estate paradise just 3 years ago. People fled California for lower taxes and affordable housing, but that California dream is turning into an Arizona nightmare. The numbers don't lie. Average property tax increase, 42% since 2021. Current median property tax, $2,100 per year, rising to projected $3,400 by 2027. Home appreciation, down 8% from 2022 peak, but taxes haven't adjusted. Water rights concerns impacting long-term values. What's really happening? Phoenix built its growth on a simple promise. Low taxes, low cost of living, endless sunshine. But the infrastructure to support 200,000 plus new residents yearly costs money. Lots of it, roads, schools, water systems, power grids. All of that requires funding. The state legislature passed laws limiting how much municipalities can raise overall tax rates. So what did Phoenix do? They dramatically increased property assessments instead. Your tax rate might look reasonable on paper, but when your home's assessed value jumps 50%, you're paying far more. Here's the real kicker. Phoenix's climate crisis is accelerating. We're talking about 100 plus days over 110 degrees Fahrenheit, increasing water restrictions, and homeowners insurance companies pulling out of the market. Your home might be worth less in 2026 than it is today, but you'll be paying taxes as if it appreciated. What you need to do, if you own property in Phoenix or surrounding areas like Scottsdale, Tempe, or Mesa, appeal your assessment immediately. The county has likely overvalued your property. Hire a property tax consultant. They typically work on contingency. Budget for 20% annual tax increases for the next 3 years. If you can't afford that, consider selling now while the market is still relatively liquid. Check your insurance policy. If your carrier has restricted coverage or raised rates dramatically, your home's market value is probably overstated. Document water access concerns. This will be crucial for future appeals and potential litigation. Market 6, Nashville, Tennessee. Nashville exploded as America's IT city of the 2000s and 10s. Everyone wanted to live where there's no state income tax, amazing nightlife, and a booming job market. But that boom is creating a tax bust for existing homeowners. The numbers: average property tax on a $400,000 home, $4,200 per year, effectively a 1.05% rate. Projected 2026 average $6,300 per year, 50% increase in 3 years. The city reassesses property every year. Most cities do it every 3 to 5 years. Recent tax hike, 34% increase approved for 2025 budget. The real problem: Tennessee has no state income tax, which sounds great until you realize that means cities are almost entirely dependent on property taxes for revenue. When Nashville's population grew by 100,000 people in 5 years, the city couldn't keep up with infrastructure needs. Now, longtime residents are being priced out of neighborhoods they've lived in for decades. A fixed-income retiree who bought their home for $150,000 in 2005 now has a $500,000 property. So their tax bill went from $1,200 per year to over $5,000 per year. Their income didn't quadruple, but their taxes did. The hidden danger: Nashville's market is cooling fast. Home sales are down 23% year over year. Days on market are up 45%, but tax assessments are based on 2022 to 2023 peak values. You're paying taxes on yesterday's valuation while living in today's declining market. Action steps: file for homestead exemption if you haven't already. It's a small break, but every bit helps. Track comparable sales in your neighborhood. If homes are selling for less than assessed values, you have grounds for appeal. Consider the Nashville Tax Revolt movement. Organized homeowner groups are filing mass appeals and lobbying for assessment reform. Calculate your true housing cost. Add mortgage plus insurance plus taxes plus utilities. If it exceeds 40% of your gross income, you're in financial danger. Have an exit strategy. Nearby counties like Williamson and Rutherford have different tax structures. Understand your options before you're forced to make a crisis decision. Market 5, Austin, Texas. Austin became ground zero for California tech transplants. No state income tax, lower cost of living, and vibrant culture made it irresistible. But the property tax reality in Texas is brutal. The shocking truth: Texas has the 6th highest property tax burden in America. Average Austin homeowner pays 2.42% of home value annually in property taxes. A $600,000 home costs $14,520 per year in property taxes alone. That's $1,210 per month just in taxes. Many homeowners are paying more in property taxes than in mortgage principal. Why Austin is worse than you think: unlike California or New York, Texas doesn't cap annual assessment increases for all properties. There's a 10% cap for homesteaded properties, but if you're an investor, second homeowner, or recent purchaser, there's no limit. Your property tax can jump 40 to 50% in a single year. The tech boom drove values sky high, but now, with layoffs at major employers like Tesla, Oracle, and numerous startups, the job market is softening. Home prices are declining. Yet, tax assessments remain elevated because they're based on previous year's peaks. The commercial collapse factor: Austin's downtown office occupancy rate is below 50%. Major tech companies have downsized their footprints. This means massive commercial property tax shortfalls. Guess who's making up the difference? You. What makes this especially dangerous? Texas has strong homestead protections. Your primary residence can't be seized for most debts, but property taxes are the exception. If you don't pay property taxes, the county can and will foreclose on your home. No bankruptcy protection, no forgiveness, you lose your house. Thousands of Austin homeowners are one job loss away from being unable to pay their property taxes. And in a cooling tech job market, that's terrifying. Your defense plan. File homestead exemption immediately if you haven't. This gives you the 10% cap and some tax reductions. Protest your valuation every single year. This isn't optional in Texas. Make it part of your annual financial routine. Join a property tax protest firm. Many work on contingency, taking a percentage of your savings. Build a tax escrow buffer. Save an extra 25% above your current annual tax bill. You'll need it. Consider downgrading if you're in an $800,000 home and struggling with taxes. A $500,000 home might save you $7,200 per year in taxes alone. Market 4, New Jersey suburbs. New Jersey has held the title of highest property taxes in America for years. But what's happening now is different. It's not just high taxes, it's a complete fiscal meltdown. Add this the devastating stats. Average property tax, $9,490 per year, highest in the nation. Effective tax rate, 2.26% of home value. In towns like Tamarack and Summit, over $24,000 per year average. Some homeowners pay $30,000 to $40,000 annually. The death spiral explained. People are leaving New Jersey because of high taxes. As people leave, property values stagnate or decline. As values decline, municipalities lose revenue. To compensate, they raise tax rates. Higher rates push more people to leave. The cycle accelerates. Real example, a friend of mine bought a home in Bergen County for $650,000 in 2018. His property tax was $18,200 per year. Today, his home is worth $580,000. He's underwater on value, but his property tax is $23,100. He's paying higher taxes on a home that's worth less than what he paid. He wants to leave, but he can't sell without taking a significant loss. He's trapped. The pension problem. New Jersey has one of the most underfunded pension systems in America. Those pension obligations are contractually guaranteed. How does the state fund them? Property taxes. This burden isn't going away, it's getting worse. Why it's about to get even worse? New Jersey passed legislation to provide property tax relief funded by borrowing. They're literally taking on debt to pay current taxes, which means future taxpayers, that's you, will pay both current obligations and past debt service. It's financial insanity. Survival strategies. Research tax appeals aggressively. NJ has specific procedures and deadlines. Miss them and you're stuck for another year. Consider the Senior Freeze program if you're over 65 or disabled. It caps your property tax at a specific level. Evaluate neighboring Pennsylvania towns. Many are 20 minutes away with 60% lower taxes. Calculate the true cost of staying. Factor in not just taxes, but opportunity cost. That $25,000 per year in property taxes is $25,000 that's not growing in investments. Don't wait for the market to improve. It won't. Demographics and fiscal reality are against New Jersey long term. Market 3, South Florida. South Florida, Miami, Fort Lauderdale, West Palm Beach, became the pandemic darling. No state income tax, beaches, nightlife, and an explosion of wealth from New York City and California. But the property tax picture is darkening fast. Current reality. Average property tax rates, 0.98% to 1.35%, moderate nationally. But home values surged 50 to 80% in 2 years. Insurance crisis adding $5,000 to $10,000 per year to housing costs. Combined tax plus insurance squeeze is crushing homeowners. The insurance tax nightmare. Here's what makes South Florida uniquely dangerous. It's not just about property taxes. You have to look at total housing cost. The $800,000 Miami condo might have reasonable $10,000 annual property taxes, but add condo association fees, $800 to $1,200 per month, $9,600 to $14,400 per year. Insurance, $8,000 to $12,000 per year, triple pre-2020 rates. Flood insurance, $3,000 to $5,000 per year. Special assessments for building repairs, $10,000 to $50,000 one-time hits. Total annual cost beyond mortgage, $30,000 to $40,000. Meanwhile, Condo values are dropping as insurance crisis makes them difficult to finance and sell. The climate reality nobody discusses. Sea level rise isn't a future problem in South Florida. It's happening now. King tides regularly flood streets. Insurance companies are pulling out. This should logically decrease property values and tax assessments, but that's not happening. Tax assessors are slow to recognize climate risk. You're paying taxes based on pre-climate crisis valuations, while insurance companies price in the real risk. The investor exit, foreign investors and institutional buyers, drove South Florida prices to absurd levels. Now they're exiting. When cash buyers disappear, markets correct hard. Regular homeowners get stuck holding overpriced properties with tax bills that don't match reality. Eat protection tactics. File for homestead exemption. Florida caps increases at 3% per year for primary residences with this exemption. Challenge your assessment using comparable sales from the last 6 months, not 2 years ago. Document insurance struggles. If you've been dropped or seen massive rate hikes, this impacts fair market value. Consider moving inland. Broward County interior versus beachfront can save $5,000 plus annually in combined costs. Watch special assessments. If your condo building needs major repairs, you could face enormous one-time charges on top of taxes. Market 2, Portland, Oregon. Portland attracts people with its progressive values, no sales tax, and outdoor lifestyle, but the property tax burden is quietly crushing residents, especially as city services decline. So on to the unsustainable numbers. Average property tax rate, 1.17% of home value. Numerous voter-approved tax levies stack on top of base rate. Effective rates in some neighborhoods exceed 2% home value appreciation, still 35% above pre-pandemic despite recent cooling, what makes Portland particularly painful. Portland has a unique problem. The city keeps passing new tax measures by popular vote, but the burden falls entirely on property owners, not renters. In a city where 55% of residents rent, the majority can vote to increase property taxes without feeling the direct impact. Result? Every election cycle brings new levies for schools, parks, homeless services, arts funding, transportation, each adding to the property tax bill. The value collapse risk? Portland's downtown is in crisis. Office vacancy rates exceed 30%. Homelessness is visible everywhere. Crime rates spiked. Major retailers closed flagship stores. This is driving residents to suburbs and other states. When people flee urban cores, suburban property values initially rise as they absorb demand, but eventually the entire metro area suffers as job markets and amenities decline. We're seeing the beginning of this cycle now. The Oregon tax twist, Oregon's Measure 50 limits annual assessed value, increases to 3%. That sounds protective, but there's a catch. When you buy a property, it resets to current market value. If you bought at the peak in 2022, you're locked into inflated assessment for years, while actual market value declines. Escape routes. Vote against new levies. Stop approving measures that increase property taxes without sustainable funding sources. Move to suburban Washington County or Clackamas County, where services are better and tax burdens lower. Consider Vancouver, Washington, just across the border. No state income tax, lower property taxes, and access to Portland amenities without the tax burden. Document declining services. If you're paying more taxes but receiving fewer services, this becomes grounds for reform efforts. Join organized tax revolt movements. Portland homeowners are beginning to organize political opposition to unsustainable tax increases. Market 1, Cook County, Illinois. Chicago and Cook County rank as the most dangerous property tax market in America. Not the highest rates, not the biggest increases, the most dangerous because of the perfect storm of factors that make this situation nearly impossible to escape. The catastrophic stats: average effective property tax rate, 2.19%, a $350,000 home costs $7,650 per year in property taxes. Some Chicago neighborhoods exceed 3% effective rate. Property taxes increased 23% in last 5 years, while home values rose only 8%. Illinois has second lowest credit rating of any state. Why this is the number one danger zone. Cook County combines every negative factor: massive unfunded pension obligations, $130+ billion, population decline, losing residents faster than any other major metro, commercial real estate collapse, downtown office vacancy nearing 25%, property tax appeals backlog, taking 3+ years to resolve, political gridlock preventing any meaningful reform, high overall tax burden, state income plus property plus sales taxes, The feedback loop of death: people and businesses leave because of taxes. Mod loss of tax base forces rates higher. Higher rates push more people out. Values decline, but assessments stay high. Homeowners become trapped in underwater properties with unaffordable taxes. This isn't speculation. It's happening right now. Chicago lost 50,000 residents in 2021 to 2022. Cook County lost 94,000 people. These aren't temporary pandemic moves. They're permanent relocations to lower tax states. The Illinois constitutional problem. Illinois Constitution prohibits reducing public pensions. Those obligations are set in stone. The only way to fund them is through taxation. Property taxes are the primary lever. This means taxes must continue rising regardless of economic conditions. Why you can't wait? If you own property in Cook County and you're financially able to leave, waiting makes your situation worse. Every year you stay, you pay higher taxes on a depreciating asset. Your home becomes harder to sell as buyer pool shrinks. Your tax burden becomes more difficult to afford. Your equity, if any, erodes further. Final action plan. File property tax appeals every year without exception. Hire professionals who work on contingency. Calculate your break-even point to sell now versus staying. Include opportunity cost of trapped equity. Consider neighboring Indiana or Wisconsin. Same job markets, 40 to 50% lower property taxes. Explore senior exemptions and freezes if you qualify. Illinois offers some protection for seniors and disabled residents. Build an exit strategy even if you're not ready to execute. Know where you'd go, what you'd do, and how you'd afford the transition. Property taxes aren't going down. In these 7 markets, they're accelerating upward while home values stagnate or decline. This creates the worst possible scenario for homeowners: rising costs on depreciating assets. The American dream promised that homeownership builds wealth. But in these danger zones, homeownership is becoming a wealth destroyer. Here's what you need to understand. This isn't about pessimism. It's about reality. Tax assessments, municipal budgets, and demographic trends are public information. The numbers don't lie. Ignoring them doesn't make them go away. Your 3 options: Option 1, fight, appeal assessments, join reform movements, organize with other homeowners to pressure local governments. Option 2, adapt, restructure your finances to absorb higher tax burdens, build reserves, increase income, cut other expenses. Option 3, exit, relocate to lower tax markets before your equity disappears and escape becomes impossible. The worst choice? Doing nothing and hoping it gets better. It won't. Do your research, run the numbers on your specific situation, consult with property tax professionals and financial advisors who understand these markets. Make decisions based on facts, not emotions or sunk cost fallacy. Your home might feel like your castle, but if you can't afford the moat, the castle becomes a prison. Take action now while you still have options, because once you're financially trapped, those options disappear fast.